Good morning, everyone. Still waiting for a few people to roll in here, but let's get started. Thanks for joining us this morning for Financial Essentials for Business. My name is Eric Delary. I'm the director of the Small Business Development Center at Blue Mountain Community College. We wouldn't be able to make this possible today without Eastern Oregon Business Source and Susan Bauer and Nick Nash, so we thank them for everything. On the line today, we also have a couple of our advisors with us, Jeff Nelson out of Baker City and Lori Skafsma out of Wallowa. If you have any questions, feel free to type them into the chat as we go along. Nick will kind of cover a few of the ground rules as well, but as all Zoom calls go, please keep yourself on mute. There will be some time for questions, comments, suggestions, discussion overall. So you can unmute during that time and feel free to interject as you will. Other than that, we just appreciate you joining us this morning. We will make some of this stuff available after the fact. So if you've got our email list to register for this, you'll also get our email when we send it out to make sure that you're able to see the video afterwards. So we cover a lot in an hour pretty typically, and it's always nice to be able to review it afterwards if you want to go back and just check here and there. So without further ado, I'll let Nick Nash take over and we can get things started.
Excellent. Thank you for the introduction, Eric. I will share my screen here and switch displays. All right, get everything set up so that I can see everybody. All right. So as I'm sure you're all very well aware, we're here for the first in the Financial Essential series called Financial Essentials. What a great place to start. So this series is going to have 4 sessions, which certainly can function independently, but I think go even better together. So congratulations on making it to the first session. It's a great place to start. We're here talking about financial essentials. Next week at the same time, we're going to be talking about creating financial reports. Then we're going to talk the following week about QuickBooks and conclude with growth and funding. So before we get into the material today, I just wanted to talk a little bit about the relationship between these 4 sessions. So today we're going to do a high-level overview of a number of items that will be helpful for the financial well-being of your business. We're going to talk about a number of financial reports and other things that are useful to know, sort of in the abstract a little bit. Then next week, we're going to attach actual numbers to these things and move them into Excel, show you how to set up these documents yourself using a tool like Excel or even Google Sheets if you have access to those things. Then in the 3rd week, we're going to take that information and move it into QuickBooks and talk about the benefits of QuickBooks and when you might choose to use that, how all of the different QuickBooks offerings relate to each other. And we'll see the transition of these things, of these numbers that we've been working with into QuickBooks. And then finally, in the 4th week, we'll talk about how to use your financial reports to grow your business and to attract additional funding if that's what you're after. So just a few words about how all of these sessions relate together. I think it's going to be a really nice collection of sessions, and I'm certainly looking forward to leading all of them. So this is the SBDC team. We see the SBDC staff there with their individual emails. The general SBDC email is at the top as well as the phone number. I will show this slide again at the end of the presentation. So if you're quickly trying to write down the information you need, you will see it again. So don't worry. And as Eric mentioned, I work for a company called Eastern Oregon Business Source. We're located in Pendleton, Oregon, across from the county courthouse. And we do a variety of different things, including strategic planning and grant writing mentorship and board development for nonprofits. leadership and professional development for various kinds of businesses, and also HR consulting and personalized trainings like the one you're watching today. So if any of those things are of interest to you, certainly reach out to Susan Bauer, who's pictured there on the left. And I will ask Susan here, do you have anything you wanted to add this morning, Susan? You must not have
No,
heard
no,
me. Oh.
no, thank you. Other than we are so excited about this partnership with the Small Business Development Center. We often will refer folks to the Small Business Development Center, and we like to support what they're doing and what businesses in our region are doing. So thanks again, Eric and advisors, for this opportunity.
Thank you, Susan. Yes, we are excited to be here. All right. So I'm sure at this point we're all pretty comfortable with video conferencing, but I find it helpful to just go over a couple of norms before we dive in, because maybe you haven't been in exactly the kind of session that I hope that this one will be. So of course, I can hear everybody is already very good at muting themselves. I really appreciate that. It makes the experience much better for everybody. It doesn't seem like anybody's called in, but just a good general principle. If you've called into something, it's nice to mute yourself on your phone. That way we won't accidentally make it so you can never talk if we try to mute you. And in addition, and this may be a little different than other sessions of this type, this session is intended to be interactive. So you can unmute yourself and talk at any time that you would like. And if you do this, it's okay to interrupt, right? In video conferencing world, we don't really have access to body language. I can see some of you moving on the screen next to me, but kind of interrupting is about the best that we can do. And that's totally okay. I promise you, I do not take it personally. You can also type into the chat if that's a little bit more your style. Totally acceptable. We have the SBDC team monitoring that in the background, and they will chime in as necessary as well. Or you can also click one of the reaction buttons, such as the raise your hand button at the bottom of your screen, and it will flash in front of me and I will call on you. So these are all of the options you have available to communicate, and I encourage you to make the most of them. And to kind of get us going, I like to hear our voices in the space a little bit. So we're talking about financial essentials today. So on a scale from 1 to 10, how would you rank your business's financial management practices? So we'll identify 1 on this scale as I'm not really sure what financial management practices are, to 10, which is move over, Nick, I'm going to teach this session. Okay, so on this scale from 1 to 10, where would you identify your business's financial management practices? I'll give you a second to think about it. And if you want to identify where you're at, that would be excellent. I see. Totally okay. I don't blame anybody for not wanting to out themselves in front of a bunch of strangers. Fair enough. Not a problem at all. The goal of these series is whatever number you identified, right? The goal for this series is to give you the tools to move up on that scale, right? So if you identified yourself as a 1, hopefully we can move you up a few chunks on the scale. I suppose if you're a 10, we'll see. Maybe we could get you to 11 or 12. I don't know. But in any case, I don't think there's too many 10s here. The idea is to give you the tools to move up a little bit, to improve your business's financial management practices, and maybe understand a bunch of things that you've heard in the past, weren't quite sure how they worked, or to clarify some things. All right, so what we're going to do this morning, I'm going to review the 7 steps to maximize the value of your business. This is from a Profit Mastery course, which was offered a few months ago by the SBDC and will be offered again at some point in the future because of its success. This is just for anybody that was in that session to kind of be refreshed a little bit. And for those that might be looking forward to taking that session, to have some of the words in their brain. We won't spend too much time on this. Then we're going to look at the most essential financial statements and discuss what is on them. We're going to see how money flows through a business. We're going to distinguish between profit and cash flow. We're going to determine the most important ratios and what they tell you about your business. And we're going to learn how to calculate the break-even point for your business. So some fairly helpful things. All right. As I promised, the 7 steps to maximize the value of your business from the Profit Mastery sessions. So the first step is to plan properly. As someone who works for a company that does strategic planning, I cannot tell you how important it is to have a plan. And this is certainly also the case with your business's financial well-being. You want to monitor your financial position. And today we're going to be talking about a variety of tools that will help you do just that. You want to understand price and volume cost. Manage your cash flow, something that's very important, especially we will see this when we get to this part in the presentation. We want to make sure that you manage growth. You don't want to grow too fast and outpace your cash flow, get yourself into a place where you ruin yourself, even though you've been successful. You want to know how to borrow properly and plan for transition. So again, something to look forward to and to keep in mind if you're interested or if you took the Profit Mastery course. All right. So we're going to begin with a quiz. I suppose always a fun place to begin. True or false? The more sales I make, the more profit I get. Seems, what do we think of that? The more sales I make, the more profit I get. Someone has to answer. Is it true or false? You can unmute yourself and let us know. You can type into the chat. You can raise your hand and I'll call on you. See people
Lindsay,
typing in.
Kathy and Heather in the chat say false, and Robin agrees.
Excellent.
False.
Excellent. It's like you've taken the quiz before, right? False. It's important not to underestimate how much it costs to make a sale, right? We may be making a ton of sales. If it costs us a lot to make each sale, right, this is obviously going to affect our profit. All right, true or false? 50% of all businesses fail within 7 years. True or false? Let's see. Someone typing into the chat. Oops. True or false? What do we think?
Ethan and Robin and Lindsay all say true.
Okay. So this one may be a trick question. You're certainly thinking in the right direction, I think, all of those who said true, but it's actually worse. 80% of all businesses fail within 7 years. And in food service, it's even higher. So again, reiterating the importance of proper financial management and probably even some luck. All right. True or false? Net worth is equal to the assets less liabilities. Net worth is equal to the assets less liabilities. All right. See true again from Ariel. Very good, Ariel. This one is true. Net worth is assets minus liabilities. All right. True or false? The best person to keep track of the finances for my business is the one who is best at math. Certainly seems initially plausible, I suppose, but what do we think? Okay, see a false. Anybody else? What do you think? The best person to keep track of the finances for my business is the one who is best at math. I will spoil the surprise. It is false. Don't be intimidated by words such as accounting or finance, right? All you're going to need to be able to keep track of your business finances is to be able to add, subtract, multiply, and divide. And in fact, after we go through the session where we set up these documents that you need, you might not even need to do that if you can tell a computer to do it for you. So don't be intimidated. It's probably best for the people in charge to know how the finances of their business is working. All right. So here we see history and the unknown. Accounting, right, is something that deals with the history. It deals with the past. It tells us what's happened. It allows us to document and record the things that have taken place in our business. Controlling or projecting, that deals with the unknown and it deals with the future. It's going to require us making assumptions or guesses about the future. It's going to ask us to think about what if. Now, finance deals with the now and the present. It will tell us what actions we should and could take. It will deal with impact, and it will help us understand our proficiency to accomplish various tasks. So something else that we might come across as we start digging into basic finances for our business is something called the accounting cycle. So this is the process of recording what's taken place and ensuring that these numbers balance. All right. So the first step in the accounting cycle, and there are various ways to present this information. So if you dig in deep after the session, you may very well come across other ways of presenting it. I certainly would be interested in having a conversation about the differences in our next session if you are so moved. But the way we're going to talk about it today begins with a classifying accounting transactions. Okay, so this is the idea that there is some transaction that your business is involved with, and you need to figure out how to classify it, which is to say, where does it need to go in the documents that you are using to keep track of your business's finances. Next, you need to record it in the general ledger, which is the record of all of the transactions that your business has been involved in. Post it to the general ledger, which involves dividing it into subgroups so that it can be useful in the future to help you identify specific things about what's going on in your business. The adjustment part of the accounting cycle, it involves something very much like the process of balancing your checkbook, right? Which is just making sure that all of the numbers work together. And these allow us to generate financial reports, which allow us to assess where it is our business's finances are at with relation to where we want them to be. Now, you may ask, Nick, why should I care about the numbers at all, right? It seems like my business is going fine. Who cares? Well, it's better to understand how hard you're working for the money you're making, right? Sometimes when we stop and figure that out, we might realize, I've been working for $3 an hour for 5 years. That's no good. It will also help you be more presentable to a lender should you need to borrow some money to expand your business or for any number of other reasons. It will make tax reporting easier and more accurate. Definitely, we're in tax season, so something to think about. It will allow you to compare your business with similar businesses in your same field, which can be very useful so that you can know where you're at and how things are going. It will show credit worthiness to a bank or credit card company or an investor if what you need is some credit or an investor. And it'll allow you to have some idea of the profitability of your business if you ever want to sell it. Okay, so these are all reasons why it's important to care about the numbers. All right. So a few tips from accountants to small business owners. The first tip is to keep your personal and business finances separate. So I'm going to just pause here and open it up, see if anybody is in the mood to talk. Why is it important to keep your personal and business finances separate? I mean, especially if you just, you own a small business, why does it matter if you keep the two separate? Very quiet this morning. Ah, I see. Ariel. No problem. Can't figure out your microphone.
I'm weary to turn mine off. My kids are running around behind me. But my benefit personally to keep my personal and business separate was just that it was a lot easier to have people write checks to my business, or and then during tax time to have everything separated.
Yes, those are both excellent reasons. And for the future, kids are certainly welcome if they scream out. It's just a thing that happens in video conference world. But thank you. It is absolutely true that your accountant will be very happy if you keep your personal and business finances separate. And as you identified, it just makes it a lot easier. That way people are writing checks to your business instead of to you. A very excellent thing. Can we think of any other reasons why it's important to keep our personal and business finances separate?
Heather wrote in the chat, so that if your business has a financial problem, it doesn't take away from your personal finances.
Yeah, I think that is another excellent reason. It allows you to separate your business finances from your personal finances. So if you run into some sort of problem, it doesn't necessarily have to sink your personal finances, which I think is something we all want to avoid. And I see Nora has also added liability, which I assume is moving in the same direction. Excellent. Tip 2, keep track of all expenses along with receipts, documentation, and proof. Now, we live in, I think, an excellent version of the world as far as this goes, right? Because if we set up a system to manage these things a little bit beforehand, keeping track of a lot of this information can be as simple as clicking a picture with our phones sometimes, right? But we want to keep track of all of our expenses as well as the documentation that details them. We want to balance the bank account every month. We'll see why we might want to do that moving forward. We want to use an accounting or record keeping method or program to categorize and record transactions. An example of this is QuickBooks, which we'll talk about in week 3 of these sessions. We'll also in week 2 show you how you can generate the same idea for smaller, simpler operations using Excel or Google Sheets. And then 5, don't wait until the last minute to file taxes. The reasons for this are probably clear. It certainly makes your tax preparer's life easier. It makes your life easier if you run into problems. It's a nice way to take a breath and leave plenty of time to work out troubles you might run into and to just make sure everything is where it needs to be. So 5 tips from accountants to small business owners. All right. Now, before we dive into financial documents, I'm just going to pause and ask if there's any questions or comments about that sort of flurry of material that we covered. Okay. Not a problem. All right. So moving forward and for the next few weeks, we're going to focus on 3 different financial reports. The first is what's known as the balance sheet. The second is an income statement. And the third is a cash flow statement. So today I'm going to talk about these at a high level. I'm going to point out some examples, but know that in our next session, we are going to make the examples precise and show how each of these relate to each other. So if there's pieces that you're wondering about now, know that we'll talk about this again in the second session, and then again in the third session. So we'll have lots of opportunity. The idea today is just to introduce the ideas, get them in our brain, and kind of give some space for them to start to take hold. All right, a balance sheet. A balance sheet is a statement of assets and future benefits and claims on those. All right. It's a snapshot in time, meaning that it just captures a moment of your financial condition. And an important equation to keep in mind is assets equal liabilities plus owner's equity. So what do balance sheets do? A balance sheet shows you what you own and what it is you owe. Okay, so what you own and what you owe. It identifies what you own free and clear, what is yours, right? And what items you're making payments on. For example, someone's personal balance sheet might include things like their house, their car, their personal belongings, and any savings accounts that they have as assets. And it would list any monthly payments due on any of those items, for example, a mortgage, as a liability. The difference between our assets and our liabilities is our financial worth. I think that we're all fairly comfortable with this, at least as a concept, right? We take our assets, we subtract our liabilities, and we end with our financial worth, a number that can, in fact, be negative. All right. It's the same with your business's balance sheet, right? Just like with our personal balance sheet. A restaurant's asset list would include things like equipment, supplies, furniture, utensils, aprons, dishes, so on. The building, if they own it. All right. A restaurant's liabilities would include things like money owed to its suppliers, payroll, and any balance that's due on credit cards or a loan. A contractor's asset list would include things like their truck, a trailer, right? Any tools that the businesses own, assets, things that the business owns. A contractor's liabilities might include things like money owned for materials, payroll, and so on. All right, a quick look at a balance sheet. It's a little bit blurry. I'm sorry about that. We have assets at the top, current assets, cash, accounts receivable, and petty cash. Then we have fixed assets, which we'll talk more about, in this case, a printer, as well as our inventory. And we add all of those up for a total assets of $2,200. Liabilities and equity, credit cards, $1,500. Accounts payable, so total liability of $1,775. Then the owner's equity plus any retained earnings. And then when we do the math, we end up with the total liabilities plus equity, $2,200. And current assets are those that we're going to use or consume within a year. And current liabilities are those that are due to be repaid within 1 year. And we will talk about this a little bit more in depth in our next session. All right. An income statement, sometimes also called a profit and loss statement, or sometimes also called a P&L. This is a statement which reports revenue, right? Money earned and received, and expresses money spent to do business. It shows the total income and expenses over a period of time, so a month or a quarter or a year. And revenue minus expenses equals profit, or if it's negative, loss. All right. So this is what an example of an income statement might look like. We see revenues there, sales, okay, $70,000. Total revenue, $70,000, seems good. Costs of goods sold, which this line can move to different places, but we have it under our expenses here. Okay. Other expenses, rent, salary, utilities, total expenses, $48,000. So we see a net income of $22,000. All right. Now, depending on what we're doing, that may be fantastic or it may be awful. It doesn't really matter what the numbers are. What's important is that we can figure out what they are. All right. Time for another quiz, just to get us interacting a little bit. So the cost of goods sold is the cost of making the product. Is that true or false? Okay, see a false from Ariel. Excellent. Anybody else? True or false? The cost of goods sold is the cost of making the product. This one's false. The cost of goods sold is the total cost incurred to make the sale, right? And this includes production, shipment, labor, overhead, advertising, all of the other expenses that are required to make a sale. Important to keep track of. Accountants advise small business owners to balance their business accounts on a monthly basis. What do we think? True or false? True. Thank you, Ariel. Anybody else? Anybody want to argue for false? No, of course nobody does. We already saw earlier it was true, right? And the reason why it's important to balance your business accounts monthly is because it's a lot easier to find mistakes when they're discovered shortly after they happen, right? If someone charged you for something that they shouldn't have charged you for, or if you charged someone for something you shouldn't have charged them for, it's a lot easier to unwind that shortly after it happens, as opposed to 6 months down the road, right? And this is part of why it's important to balance your business accounts on a monthly basis. All right, true or false? An income statement shows how expenses affected cash flow during a specific time period. No, we might not know what this means. An income statement shows how expenses affected cash flow during a specific time period. No. An income statement reflects the revenues and expenses during a specific time period, but it doesn't demonstrate how the cash was used. And this is a leading question because it takes us to the cash flow statement. The cash flow statement is a report of actual dollars in and out, and it measures the ability to be financially effective in the short run for our business. If we have enough cash on hand to be able to pay our bills, and it identifies where our cash is going. So a cash flow statement, it shows us how our cash was used to do business. It's typically broken down into 3 sections: operations or operating expenses, investing or investing expenses, and financing. So operations is all of the costs to do business. And generally speaking, I think this is where most of the action happens in our cash flow statement. Certainly, I think, depending on your type of small business for small businesses. Investing includes any money that you spent to buy new equipment, right? Or things to invest in your business, or any proceeds that you've made from selling those things. And financing involves any money coming in or out based on paying off loans and so on, the financing for things. All right. A cash flow statement shows where money comes from and where it's going. Purchasing more inventory increases your total assets, right? We remember that from earlier, but you need to pay for that inventory. So a cash flow statement shows how your available cash is being used to create the increase in inventory, but buying new inventory is an expense. So it's shown as a decrease or outflow of cash, right? And a warning here. A primary cause of the failure of successful businesses is uncontrolled growth, right? A company or a business can grow too fast and not be able to handle its cash flow needs. So an example of what we might have in mind here. So I live in Pendleton, home of the Pendleton Roundup. You imagine you started your business 2 months before Roundup in a year when Roundup happens, and then Roundup happens, and man, you're making lots of money because there's lots of people around buying the things that your business sells. You want to be very careful to properly manage your cash flow. You don't want to think that every month is going to be like September in Pendleton, right? I assure you it's not. I live here. And so you want to be very careful. You don't want to, based on that giant influx of money following from all of the people being around, take out a bunch of new liabilities that you won't be able to pay for when business starts to drop off in the future. Similarly, if you just open up and things are going really, really well, you want to be careful to manage your cash flow so that you can grow under control. You don't want to have to accidentally hire people that you then have to lay off in the future. All right. So this is one of the ways that a cash flow statement can look. And again, we'll dig into the details of these in the next session. So as I said, we see cash flow from operations. All right. Net income, adjustments for depreciation, something we'll talk about, adjustments for increase in inventories. There we see that as a negative, adjustments for the decrease in the accounts receivable, and then our net cash flow from operations, cash flow from investing, right? Receipts from the sales of property and equipment, awesome. Cash paid to purchase these things, and then our net cash flow from this, and then cash flow from financing, generally a negative number, cash paid for loan repayment, and so on. And we end up with either a positive or a negative number. In this case, it's positive. It's a net increase in cash. And there'll also be a section of the cash flow statement that shows your starting cash, right? Your increase or decrease in cash, what we see there at the bottom. And then it identifies our ending cash. So this will tell us how much cash it is we have on hand and where it is the cash went in our business. So that was, again, a high level and pretty furious overview, but I'll just pause and ask if there's any questions about any of that material. And again, we're going to go over it next week. We're going to go over it again the next week. Okay. Certainly, if you have any questions about this, the fantastic team at SBDC are excellent people to talk about about the financials of your business. They are there to help. I get the impression that this is the kind of thing that excites them to work with people about. So know that they are there as a tremendous free resource to help you out. All right. So now we're going to talk about ratios. And we're going to talk about them at a pretty high level. I'm going to go pretty quick, and we'll see next week that the things like Excel help us pretty easily identify and figure these things, right? Ratios focus on numbers from your accounting records, and they set two numbers into a ratio that we can then use to track trends. And it's important here to say the trends are more important than the numbers. The numbers just tell us what's happened in the past, but trends show us which direction it is we're heading in the future. And I'll also just identify here that what these ratios will be for your business can vary depending on what type of business it is you're in. So I'm going to give a few sort of basics about this stuff as we go through it over the next couple of minutes, but know that the ideal ratios can change depending on what industry it is you're in. All right. So to kick us off talking about ratios, I'm going to talk about a few different types of financial ratios. Then I'm going to talk about specific ratios. So one type of ratio are liquidity ratios. These evaluate a business's ability to pay its short-term obligations, and it's used by banks to decide whether or not to loan money. Right? We've heard this idea, are you liquid? How liquid are you? Right? Liquidity, excellent. Leverage. This evaluates how much debt a business has, and it's a comparison of assets to debts. We've all heard this, I suspect. How leveraged are you? How leveraged is your business? All right. Efficiency. This analyzes how much a business spends to make a dollar. And it's used to judge the management of a business, right? Okay. Operating ratios. These compare expenses as a percentage of revenue. And banks prefer this number to be low because it suggests that expenses are a small cost of making the sale. I think what we all would want. And profitability. This is the capacity to make a profit. And it determines the bottom line for managers and a return on equity for investors. All right. As I promised, we're now going to talk about the four most common financial ratios. The first is the debt to equity ratio, then what's called the current ratio, then a return on equity, and finally, net profit margin. And again, if this information is just starting to swim around in your brain, totally okay. We're going to talk about it again in the next session and then again in the next session. So we're just trying to get the ideas out so that we have them to work with moving forward. All right. Debt to equity. This is total liabilities divided by shareholders' equity. So we have our example there, $50,000 in total liabilities divided by $120,000 in equity, leaves us with a 42% ratio. So this tells us that for every dollar in equity, the company has 42 cents in debt. So debt to equity ratios of less than 1 is ideal. Bankers consider a debt to equity ratio of 2 to be risky. So notice that you would have twice as much debt as you have equity, right? And in our example, we had $1 of equity for 42 cents of debt. So pretty good. All right. Current ratio. So this is the most important measure of liquidity. This is current assets divided by current liabilities. Okay. So what this is telling us is, can you liquidate your current assets and cover your current liabilities? I think just hearing that hopefully can make some sense about what the usefulness of this ratio is. So let's consider Charlie's contracting business, okay? So we'll say that his current ratio, $25,000 in current assets, $100,000 in current liabilities. He's just starting out, probably not that strange of a place to be, right? So he has enough current assets to pay off 25% of his current liabilities, right? He's highly leveraged, and this is a pretty risky situation, depending on the nature of his business, certainly, right? We'll hope that he is now working forward to change the ratio. But if he needs to borrow more money, he may be pretty risky. Banks prefer current ratios of 1 or 2, right? So that the current liabilities would be covered by the current assets. I think that this just sort of intuitively makes sense to us, right? Banks love to loan you money when they know that you have enough money to pay them back at any time. All right. The higher the ratio, the better. And a ratio of 4, for example, means that a company has 4 times more current assets than it does current liabilities. Awesome. All right. Return on equity. This is a measure of profitability. The return on equity is the amount of net income returned as a percentage of shareholders' equity. This estimates the profitability of a business by showing the amount of profit generated with the money invested by its owners. It's net income divided by shareholders' equity or owners' equity. This is similar to a person putting cash, right, into an investment. We can think about it that way. The person will want to know what their money is making for them in their investment. And in other words, they want to evaluate the success of the investment by knowing how hard the money is working for them. The higher the return, the more profitable the business. All right. Our last ratio, net profit margin. This is a pretty useful one. It's a measure of efficiency to control costs. A higher net profit margin shows more efficiency of the company at converting its income into actual profit, right? The ratio is a good way of making comparisons between companies in the same industry. And it's net profit divided by net sales is the most basic way to come to this ratio. So, for example, $15,000 in net profits on $45,000 in net sales gives us 33 or 33%. All right. So 33% or 1/3 of every dollar of revenue turns into profit. And again, what this ratio means has a lot to do with what kind of business it is you run. 33 may be amazing, like unreal, or it could be awful. The numbers themselves they're not good or bad, right? They have to be put in context. So 33 cents of profit is generated by every dollar of revenue earned in our example, right? Now, why might we care about this? Well, imagine a restaurant where sales are increasing, right? But the cost of ingredients is also increasing. This could cause a lower or shrinking net profit margin, even though the sales are increasing, right? So net profit margin is important to keep track of because it gives us a better picture of how our profits relate to our expenses, better than just simply looking at our total sales, right? We're breaking sales records every month, but our expenses of doing business are also going up. And so our net profit margin is going down. That might not be a great situation. Okay. The final part of our presentation today, the break-even point. So the break-even point is how much do I have to produce to break even? What's the price I need to charge to break even? It will also help us figure out. So break even is total fixed costs divided by total sales minus total variable costs divided by total sales. Okay, wow. All right. It's a lot. It's okay. We will look at this again. It'll become clear as we move through the material. This is a tool to help decision makers, but notice that it doesn't look into the future. It just sort of tells us what's going on now. That being said, it can certainly help us make decisions about the future based on our current conditions. All right, break even equals total fixed costs divided by total sales minus total variable costs divided by total sales. Wow. All right, here we go. So our Total fixed costs, $666,000. Okay, our total sales, $150,000 minus total variable sales divided by total sales. All right, we see 90,000 divided by 150,000. All right, 666,000.6. Okay, equals 111,110. All right, so this would mean if these are our monthly numbers, that the break-even point we reached will be reached at an average of $110,000 per month. All right, so we have this, great. There's one more step. So if the average dollar amount per guest in our business is $45, right, and our break-even point for monthly sales is $111,000, we can see break even minus the number of guests, right? That we're going to need 2,469 guests, or 83 guests per day, spending $45 a piece to break even. And again, this could be a really, really low number, or it could be impossibly high. It depends entirely on what it is we're doing and what our business does. But this can give us some idea of where we break even. And notice, break even just means that we are paying off all of our liabilities. It doesn't mean that we made a profit. Everything after the break even point is the profit. And I promise that we'll present a few different versions of this break even point in our next session as well. And in fact, the one after that, I keep saying that, sound like a broken record. In any case, things to look forward to, I suppose. All right, so we're coming to the end today. And I'm wondering, what was the most helpful or interesting to you from today's presentation? Or what would you like to learn more about that you heard a little bit about in our next session? I'll just pause and watch the chat, or let you unmute yourself and hear what was helpful or interesting, or what was sort of alive and in your brain that you'd like to think more about next time, so that we can adjust accordingly.
Nick, for me, I'll just share real quick, but it's always good as a reminder to hear that, you need to make sure you're looking at your finances on a monthly basis. I know that sometimes when we allow that to go a little bit too far, well, it makes a lot more work at the end of the quarter or the next time we decide to do it, but it really helps keep things in check every month, and it really makes you a lot more precise in making sure that you're profitable.
Yeah, I can second that. I had a very similar experience myself putting this together for this morning. Go ahead, Susan.
Nick, I'll add to that and say I really liked one of your earlier slides where you assured that I, as a small business owner, does not have to be a math genius. If I can add, subtract, multiply, divide, I'm going to be okay. And I particularly like how, more importantly, you said there are programs, there are systems, i.e. Excel, QuickBooks, others. That's going to do the math for me.
Yeah.
So that was very reassuring to me. I can probably find the numbers and put them where you tell me, but I don't have to be a real math wizard.
Yes, very, very true. Yeah. And I see Nora has entered in the chat that she'd like to learn more about the benefits of various formats of a cash flow statements. Something I will make sure to include next time. Thank you for the comment, Nora. Is there any other things that people found interesting or that they'd like to learn more about?
Nick, I find it's really good to have reminders of keeping your personal finances separate from your business finances.
Yes.
I help lots of solopreneurs, and they're sole proprietorships, and that concept is sometimes very difficult to get across, that you really want to look at your business as something you're going to sell in the future. It is not you. It is an entity you are creating so that potentially you can sell it or give it to an heir, something like that. So you have to, from day one, you need to think of your business as something that you will It's separate from you. You will have it in the future. Someone else will have it in the future, hopefully.
Yeah. Fantastic. Thank you, Lori, for saying that. I think that that's tremendously important. And as you said, someone who deals with that and trying to convince people of it every day. Excellent. Anybody else? Okay. So I do want to get to the last couple of slides. Just going to review, of course, today. Next, we're going to talk about creating financial reports, how all of these numbers relate to each other, QuickBooks, and then growth and funding on the following Wednesday from 9 to 10. All of the sessions are also available through YouTube. And I will put this up and ask if there are any more questions. Ariel, looks like you unmuted yourself. Did you have a question?
Yeah, I finally figured out how to unmute myself.
Excellent. Very good to hear your voice.
I guess, is it helpful to already have QuickBooks downloaded before we start this that QuickBooks session, what, in 2 weeks?
So that is entirely up to you. I mean, I think that if you are honestly at all on the fence about using QuickBooks, my suggestion is, yeah, just dive in and have messed around with it a little bit or not before the session. So if that's sort of the direction that you're leaning, I think that that's fantastic. It is not a requirement. So it will be in a lot of ways kind of an overview of how you would create these documents in QuickBooks should you be so moved. So certainly you're welcome. Go ahead.
Oh, I said yes. Thank you. Thank you.
Yeah, no problem. Excellent question. I appreciate it. All right. Are there any other questions or comments or parting thoughts before we move on? Okay, well, should they come up, certainly feel free to reach out to the SBDC team. Otherwise, I look forward to seeing you all next Wednesday. And I really appreciate your time and attention today. And thank you so much for making it to the session this morning. I hope that you all have a good day, and we'll see you next week.